The digital gold trade just got embarrassed in public. Bitcoin is down roughly 26% over the last year, at the exact moment real gold is printing fresh all-time highs. Not up a little, new highs, while Bitcoin bleeds. And this is the part nobody can hand-wave away. This was supposed to be the easy cycle. The US turned friendlier. Spot Bitcoin ETFs finally went live. The suits were supposed to walk in with billions and calm the chaos. The narrative was lined up like a perfect bowling shot. Instead, the ball flew into the gutter. So what actually happened? Did the Bitcoin story break? Or did the market just run the oldest play in the book? Shake out the impatient, reprice the risk, and reload for the next leg. Because one of the earliest architects behind the machinery Bitcoin runs on, someone whose work is literally referenced in the original 2008 white paper, walked into a closed-door investor room and delivered a message that flips the way you should interpret this drawdown. Not a hype speech, not a meme, a map. And if you understand the map, you stop reacting to candles, and you start reading the cycle. Quick intro before we dive in. You're watching an independent market breakdown. No sponsors, no shilling, just the clearest explanation of what the tape is doing and why. Now let's talk about the setup everyone believed in, and why that belief got punished. Going into this cycle, the story was almost too clean. First, the ETF gate finally opened. For years, every attempt to launch a spot Bitcoin ETF got rejected, delayed, dragged through lawsuits, and treated like radioactive waste. Then suddenly, approval. And that was a big deal, because it meant Bitcoin could be bought inside a normal brokerage account without touching an exchange, without custody nightmares, without seed phrases, without "oops, I lost my wallet." That's not a small change. That is a distribution upgrade. Second, the political mood shifted. The tone moved from "regulators are coming for you" to "we want innovation here." For institutional allocators, tone matters. They don't want hero trades. They want permission. They want clarity. They want to know they won't wake up to a headline that turns their compliance department into a bonfire. Third, the macro backdrop looked like Bitcoin's home field. Big deficits, sticky inflation psychology, constant debates about currency debasement, a world where trust in institutions is thinner than people admit out loud. This is where the hard asset thesis is supposed to shine. So in everyone's head, the logic was straightforward. ETFs bring sticky money. Sticky money smooths volatility. Smoother volatility attracts bigger money, and bigger money pushes Bitcoin up like a rising tide. That was the theory. Then reality punched it in the mouth. Bitcoin fell anyway, and the contrast made it feel personal. While metals absorbed fear and hedge flows, Bitcoin acted like a risk asset having a bad week. That's why you felt the mood shift online. Not just fear, betrayal. People started whispering the uncomfortable question. Maybe Bitcoin isn't digital gold. Maybe it's just a high beta tech proxy with a better marketing team. And right there, when sentiment starts rotting at the edges, that's when the useful voices matter. So here's the voice you need to understand. Adam Back isn't a commentator. He's embedded in Bitcoin's spine. Before Bitcoin had a brand, he created Hashcash in the 1990s, a proof-of-work system that inspired the very mechanism miners use to secure the network. That's why the white paper cites the concept. That's why people who actually know the lineage pay attention when he talks. He spent decades watching these markets do what they do: seduce the crowd, punish the crowd, reward the patient, humble the confident, and repeat. At a private investor conference, in a room full of serious money, not retail traders, he said something that sounds obvious until you realize what it implies. Bitcoin is generally volatile. Yeah, no kidding, right? But that sentence wasn't a shrug, it was a diagnosis. Because the real message wasn't, "it's volatile." The real message was, volatility is not evidence the thesis is broken. Volatility is evidence you are still early. And that changes everything. Let's break down the full thesis in plain English, and then we'll translate it into a playbook you can actually use. First, this looks like a cycle, not a collapse. Bitcoin has a habit, a rhythm, a 4-year heartbeat that the market has learned to trade around. You get a supply shock narrative, a run, a mania phase, then the hangover. And in the hangover, people start writing obituaries. Back's point was brutally simple. We've seen this movie. The people shocked by the drawdown are reacting like this is the first time Bitcoin has ever disappointed. It isn't. The disappointment is part of the design of the experience. But here's the twist. Even insiders expected some smoothing this time. Because with ETFs, you're not just bringing in new buyers, you're changing the type of holder. So why didn't that instantly fix it? Because the old participants didn't disappear, they adapted. There are still sophisticated traders who treat the historical pattern like a calendar. They position for dips because the dip has historically shown up. They sell strength because strength has historically been punished at some point. They don't need the thesis to change. They just need liquidity and predictable human behavior. BAC essentially flagged that some market participants are still trading around that historical pattern anyway. Translation: the cycle is still being played, even if the stage got nicer. And then he added a line that should make you stop doom scrolling. Some people think the price comes back later in the year. Not a guarantee, not a promise, a behavioral observation. The kind of observation you only make when you've watched this tape for a long time. Second, ETF holders are stickier, but the institutional wave is still early. This is the part the headlines keep skipping because it doesn't sell panic. There are two big buckets of Bitcoin exposure right now. Bucket one is the reactive crowd. They buy late. They buy because price is up. They buy because a chart looks confirmed. They use leverage. They chase. Then price pulls back and they don't have a plan. They only have emotion. When they feel pain, they exit. Bucket two is the portfolio crowd. ETF holders, retirement accounts, allocators who think in percentages instead of dopamine. They aren't watching 5-minute candles. They rebalance. They average. They have committees. They don't liquidate because the timeline is measured in quarters, not hours. That's the sticky money everyone was waiting for. BAC acknowledged that stickiness is real, but then he said the quiet part out loud. There still isn't that much institutional capital in Bitcoin yet. Read that again, slowly. Despite the ETFs, despite the big names, despite the social media victory laps, the true institutional allocation wave, pensions, endowments, sovereign funds, giant asset managers shifting policy allocations, has not fully arrived. What you saw was the door opening. You have not seen everyone walk through, and that explains a lot, because if the new sticky holders aren't dominant yet, the price can still be whipped by the old behavior. Leverage, liquidations, panic selling, and the classic make everyone feel stupid cycle. Third, volatility is the tax you pay for being early on an adoption curve. This is where BAC's long-term thinking shows up. He compared Bitcoin's stage to early Amazon-style volatility, not because the assets are the same. Don't confuse the analogy. Because the pattern is the same, a thing the world will eventually understand. Before the world understands it, it trades like a live wire. Early Amazon wasn't a stable blue chip. It was a story the market couldn't price. Big drawdowns weren't proof Amazon was fake. They were proof the market hadn't settled on what Amazon was worth. BAC's argument is that Bitcoin is in that same discovery phase, an asset still being integrated into the financial system. When something is being adopted rapidly, every new buyer cohort changes the price. Every new regulatory signal changes the price. Every liquidity event changes the price. Every risk-on or risk-off wave changes the price. That's volatility. Not as an accident, as a feature of early monetization. And as adoption matures, that volatility should naturally compress. Not disappear, compress. Because the holder base becomes more diversified and less emotional. Because the asset becomes more familiar. Because liquidity deepens. Because the unknown becomes known. Fourth, the gold comparison is the right measuring stick, and it's still a huge gap. BAC framed the long-term potential using market cap reality instead of vibes. Gold is a giant, a multi-trillion-dollar store of value the world already accepts. Bitcoin is still smaller, by roughly an order of magnitude depending on how you measure it. So if Bitcoin keeps stealing even a slice of that store of value roll, the upside ceiling isn't a meme number. It's a scaling argument. Bitcoin doesn't need to replace gold to matter. It doesn't need to become the only money. It just needs to be taken seriously by a bigger percentage of global capital. And if that happens, the gap between today and gold-sized is the space where cycles happen. Now let's translate all of that into what it means for you, right now, in this specific moment, with Bitcoin under pressure and the internet losing its mind. Here's the first rule. Stop judging Bitcoin by a 12-month window. A 12-month window is a microscope. It makes every move look like destiny. But Bitcoin has always punished microscope thinking. Because the people who win are the ones who use a telescope. The 4-year rhythm matters. The decade-long adoption curve matters. The shifting ownership structure matters. If your entire conviction depends on what Bitcoin did since last spring, you don't have conviction. You have a mood. And markets eat moods for breakfast. Second rule, know who owns the asset because ownership drives behavior. If Bitcoin is dominated by leveraged traders, it trades like a leveraged instrument. If it's dominated by long-term allocators, it trades like a store of value. Right now it's a hybrid, which means it can act like gold in one window and act like tech in another. That doesn't mean the thesis is dead. It means the transition is incomplete. Third rule, the real question is not, why is Bitcoin down? The real question is, where is the slow money? Backsline, there isn't that much institutional capital yet, is the clue. Pensions don't move fast. Endowments don't move fast. Sovereign funds move at glacial speed. They need policy decisions, risk committees, custody solutions, auditors, legal sign-offs. The ETF approval is step 1, access. Step 2 is allocation. And step 2 is a process. That's why you should watch the data that reflects process, not emotion. Flows, holdings, allocation reports, policy shifts. The slow money doesn't show up as a single candle. It shows up as a trend that looks boring, right until it becomes obvious. Fourth rule, volatility is not your enemy. Your reaction to volatility is. Volatility is what makes people sell the bottom and buy the top. Volatility is what makes people abandon a thesis at the worst moment, right when the risk premium is highest. If you don't have a framework, volatility becomes a weapon used against you. So build the framework. What would actually change your mind about Bitcoin? A technological failure? A sustained collapse in adoption? A global regulatory shutdown that permanently blocks access? A credible replacement that solves the same problem better? Those are thesis-level questions. Prices down this year is not a thesis-level question. It's a feelings question. And feelings are not a strategy. Now you might be thinking, okay, but why did gold win and Bitcoin lose in the same window? Because markets don't always price narratives the way you want them to. Gold has thousands of years of credibility baked in. Bitcoin has 15. Gold is universally understood. Bitcoin is still misunderstood by a huge share of the capital pool. In a moment when investors want to hedge, they grab what their committee already approves. That's not a moral statement, it's a process statement. Bitcoin's job in this era is to graduate from interesting to standard. And graduating takes time. Here's the cliffhanger nobody talks about. If back is right, if the institutional wave is still early, then this drawdown isn't proof the party ended. It's proof the party hasn't even started. Because the day the slow money actually allocates in size, the market structure changes. You don't just get a price move, you get a personality change. But there's another cliffhanger too. If institutions are still early, then who's been setting the price? Mostly the same players as always. The traders, the leverage, the reflexive flows, the people who can press the market down and make the headlines feel like gravity. Which means the price you're seeing may be more about positioning than value. And if that's true, then the question becomes dangerously simple. When the next leg begins, will you be positioned, or will you be watching from the sidelines, waiting for confirmation again? Because the market has a cruel habit. It offers you fear when the risk-reward is best. Then it offers you euphoria when the risk-reward is worst. So here's a practical way to think about the next phase. There are 3 time frames living inside Bitcoin at the same time. The short time frame is traders fighting over liquidity. The medium time frame is the 4-year rhythm, where people front-run supply narratives and then fade them. The long time frame is adoption, the slow march from niche asset to globally held store of value. Back's message is, don't confuse short-term noise with long-term trajectory. And don't confuse the chart hurt me with the thesis died. Now let's get specific about the psychology, because this is where most people lose the game. When Bitcoin drops, your brain does something primal. It searches for a reason that feels certain. It wants a villain, a betrayal, a broken promise. That's why the internet becomes a courtroom. ETFs were supposed to pump. Institutions were supposed to buy. Bitcoin was supposed to hedge inflation. And yes, those stories existed. But markets don't pay you for repeating stories. Markets pay you for timing the gap between story and adoption. Sometimes the story arrives early. Sometimes the adoption arrives late. And in that gap, price can do ugly things. The ugly things are the tuition. Now, none of this means Bitcoin must go up later this year. Nobody gets to promise you that. And keep it real about risk. Bitcoin can rip your face off in both directions. If your position size turns every dip into panic, it's too big. If you don't have cash flow, an emergency fund, and a plan, the market will force you to make decisions at the worst possible time. What you can do is stop being surprised by the way the asset behaves. If you treat Bitcoin like a guaranteed hedge, you will be disappointed. If you treat it like a young store of value still climbing the trust ladder, the volatility makes sense. Back's point is that we are still climbing. And if we are still climbing, then the volatility isn't a sign of failure. It's a sign of adolescence. And adolescence is messy. So what do you do with that? You stop anchoring to last year's price. You stop letting social media emotions write your strategy. You decide your timeline. You decide your risk. You decide your framework. And you execute like a grown-up, not like a tourist. One more cliffhanger before we close. The most dangerous moment in any cycle is the moment when the crowd stops believing, right before the next narrative ignites. That's when the market feels dead. That's when people get bored. That's when people capitulate. And that's when the setup for the next move quietly builds. If the slow money is still early, this is the zone where boring can flip into sudden. And if you wait until it's obvious, you'll pay the obvious price. Now here's the deal. If you want more breakdowns like this, fast, direct, no fluff, subscribe. One click, that's it. Because the next videos will track the signals that actually matter. Flows, structure, and the moments the market tries to trick you. And I want your take in the comments. Do you think Bitcoin is still on a path to behave more like gold over time? Or do you think it stays a high beta risk asset forever? And second question, what would have to happen for you to say, honestly, the thesis changed? A specific event, a specific regulation, a specific technical shift? What is it? Drop your answers below. Read other people's answers too. The crowd psychology is part of the chart. And keep your eyes open. Because the next phase doesn't announce itself with a trumpet. It starts quietly, and then it becomes impossible to ignore.